In 2018, you couldn't walk into a startup office in San Francisco without seeing the exact same pair of shoes. This city functions as a tight-knit ecosystem. When a trend takes hold here, it becomes a uniform almost overnight. This gray wool sneaker was a specific cultural signal. Wearing them told every other founder and venture capitalist in the room that you were an early adopter who prioritized sustainability. The brand launched with a singular focus. Instead of managing a catalog of hundreds of variations, they offered one hero product made from one natural material. They built their entire identity on the absence of complexity. This chart illustrates their early economics. By selling directly to the consumer and bypassing traditional wholesale middlemen, the company captured the full retail price. The resulting profit margins were significantly wider than the industry average. Because the shoe became a viral uniform spread through word of mouth, customer acquisition cost stayed near zero. In those early years, the business functioned as a highly efficient engine for generating profit. That efficiency attracted massive infusions of venture capital, driving the company's valuation into the billions long before they ever expanded their product line. But the core product had a specific limitation. Shoes are durable. Most customers don't replace a pair of wool sneakers every few months, nor do they typically buy multiple identical pairs in a single year. This creates a fundamental tension. Venture capital expectations require a steep upward curve of compounding revenue growth, while the reality of footwear is a flat line of infrequent repeat purchases. To meet those aggressive growth targets, Allbirds began to move away from the focus that made them profitable. They traded their simplicity for scale. They rapidly expanded their catalog to include dozens of new items, like running shoes and underwear, while simultaneously building an expensive retail footprint. These stores featured custom wood interiors and sat on premium real estate. Digital branding relies on low overhead. Physical retail relies on fixed mathematics. Suddenly, the company was responsible for high-end commercial leases, full-time staffing, and the logistics of a physical supply chain. As this chart shows, overhead climbs because physical stores require massive stock. Millions in cash gets tied up in inventory across every size. These fixed costs narrowed their margins on every shoe sold, dismantling their profitable unit economics. At the same time, their digital advantage disappeared. Wool is not a patentable moat. Competitors soon flooded the market with identical sustainable sneakers, just as the cost of advertising on meta platforms began to skyrocket. Without high customer retention, the brand ended up on a treadmill. They were forced to pay high ad rates and fixed retail rents just to maintain their current revenue, leaving no room for profit. In 2020, the market shifted. The transition to remote work made the tech commuter uniform irrelevant almost overnight. Foot traffic in those expensive stores vanished, but the warehouses were still full of an expanded, multi-product inventory that was no longer moving. Physical inventory is a financial liability that costs money to store. Eventually, the company had to liquidate that stock to recoup whatever cash they could. They turned to continuous clearance sales, offering 30% and 40% discounts. This solved the inventory problem, but destroyed the brand's premium identity. Once a company trains its audience to wait for a discount, it loses its status as a premium symbol. The shoe was no longer a signal. It was just a commodity. Allbirds eventually went public, achieving a billion-dollar valuation based on years of brand hype. The public market, however, prioritizes sustainable profitability over top-line growth. It requires a business model that works when the hype fades. Investors found a combination of rising acquisition costs, weak repeat buying behavior, and a balance sheet burdened by heavy inventory. The stock price reflected those findings, dropping over 90% from its peak. This crash led to immediate store closures and widespread corporate layoffs. This shaded area represents the billions of dollars in market capitalization, erased in just a few years. Allbirds sacrificed a focused, profitable identity to chase an unsustainable scale. They moved from a business that worked to a business that was merely large, and in the process, they lost the simplicity that made them valuable in the first place.